And good morning. This is Sterling Smith and Brooks York, ready to bring you the July 3rd Thursday ASNA Edge marketing meeting. We have quite a few items that we're going to talk about today, but the first thing we're going to talk about is what happened on Friday with the July WASD report. And we go.
Sterling, you've been out gallivanting across Europe. We had a guest in on a Friday, Matt from Bloomberg. He joined us from London. And while the numbers didn't look a lot different, there was a slight change to that ending stock, as you can see on there.
Exactly. And this is a copy, more or less, of what the USDA balance sheet looks like. This big number, the ending stocks number, what we have left over after we use everything, actually went down a little bit. We went from 2.102 to 2.097. So we cut things by 5 million bushels. It didn't really affect the stocks to use that much. What's driving the market dynamic now is how we got here. So how we managed to get a lower ending stocks number when, if we look at production here, production was increased by 240 million bushels. Okay. Ordinarily, we would see that added mostly back into ending stocks. What the USDA did was, on last year's balance sheet, they increased exports, meaning they pushed up old crop exports a little bit and cut our ending stocks. That accounts for a big chunk of this, about half. What they did here is if you look at our export number here, they increased that by 25 and our domestic use by 75. That accounts for the other half of this. Question is, how much does the market actually believe this? We see the initial knee-jerk reaction, the reaction of that day, and then reality begins to set in. So our big driving question we have with this balance sheet isn't so much exports, they can go up a little bit, and these changes are actually by percentage very, very small. The big number right here that we need to look at and think about is where our yields going to land. 181 bushels per acre would be the best all-time corn production by 4 bushels an acre. That is not something that's going to be necessarily that easy to do. The weather here actually has managed to get better. We are seeing we saw some pretty good heat over the last 2 weeks. I left town just in time. We're expecting to see some beneficial rains this weekend and a little more heat. If we can get one more round of rain, between now and August 15th, that is going to put us in a pretty good spot in terms of precipitation for both corn and soybeans. Is it enough to get us to that 181 area? That I don't know, especially when we have increased our harvested acres to a fairly substantial amount. Normally, when we see acres increased, that is something that will generally weigh on yields a little bit. Brooks, how are conditions down by you right now?
You know, Sterling, they couldn't be a lot better, much better. Really, we've had rains pretty much on cue. There's some areas that have excessive rain, but when you see those flooding pictures, you know the benefits go far beyond the lost acres and flooding to those upland acres. You know, I've seen some typically, you know, that 181 seemed like that was going to be quite a hill to climb. We had talk of La Nina. Of course, Jeff was on with us 2 months ago, talked about La Nina's effect in the Western Belt probably as early as June and July. That has not happened. We've seen some yield estimates, some private estimates out there as high as 182 to 184. And,
Right.
you know, if you look in our backyard and what you see in your backyard, it's a rarity for these conditions to actually get better. If you look at the crop conditions, like a historic, Sterling, you do a good job of putting these out. Historically, we see the old adage that our highest yields are when the corn is in the seed bag. It actually tails off. We're actually seeing kind of a maintenance of a pretty good crop here.
Yeah, crop conditions normally tail off as time moves on, as weather takes its toll in places. But we are being, much like interest rates, higher for longer with crop conditions. We are holding up very, very well. In fact, on a seasonal basis, this is the best crop conditions we've had. So again, we are already, it's July 17th. Okay. I'm starting to work on my fantasy football draft. We're getting deep into the second half of the game here. And in 4 more weeks, when we have this meeting, we're going to have a really clear idea where this corn crop is. Right now, Planalytics yields are right in that 178, 179 area, and that was from a week ago. And we'll save the soybeans for when we get there. So, is Koufax pitching the perfect game? Well, we're in the 5th inning, and so far, no one's gotten to first base. So, that number, will we reach it? Probably not. I'm guessing we'll come up a little short. But there's another dynamic in this equation. Right now, we have harvested acres at 82.1. With good conditions, Brooks, could that turn into 82.3?
Certainly could. We kind of look at a number there. If you go back and you look at history, it's about 92.4% of planted acres are harvested. And we saw some significant flooding, in that Iowa, a little bit in the Dakotas, southern Minnesota early on. We saw a little bit more flooding in Illinois over the last weeks. But as far as those types of things, while they're catastrophic, I don't want to downplay those, are pretty much factored in and expected on an annual basis. The areas that have not seen that excessive flooding that we kind of expect to, like the Delta, they don't seem to have had that big issue like we've seen there in the past.
So, yes, we might get the yields, but moreover, we shave a little off the yield, but if we add, 2/10 to this number, seeing this total production number coming at 15.1, yeah, it's a possibility. If we were going to have it, things would look like they look right now. So with that
Certainly,
being
one thing, we talk about all these things. We're not quite out of the woods yet. One thing I have noticed with traveling across the Midwest is the corn might be a little bit behind where it normally is. So this weather, I know pollination is the most critical time, but to really finish out that perfect game like Sterling's talking about and go all the way through 9 innings, you really, we can't. I don't want to downplay the importance of weather in August. It has a lot to do with how well that top end corn yield is. So we've still got a ways to go.
yeah. And whether or not we get some rains 2 weeks from today, 1st of August, that first week or 2 of August, if we see a good, meaningful rain across most of the Midwest, that's going to pretty much set the mold for things here. So, with that, our friends on Wall Street have been selling corn almightily. We're down to a net short of negative 321,000. This is the second largest short position ever. The shortest actually came and happened in late February of this year, with them being short about 15,000 additional contracts from where they are right now. The good news is most likely we're getting very close to that area of maximum short, meaning we are not going to see a lot of selling pressure coming in from the funds. They might be willing to add a little bit, but they're not going to be willing to add in mass at these levels, I don't think. So that does create a situation where we may be able to get some short covering and some pops here and there. On the commercial side of things, again, right now, December corn's at 405 3/4. I would expect if you're a commercial buyer, you're interested in buying at 405, you're going to buy at 4. You're not going to let it probably string above 410. So there is some potential fuel for some buying here if we get the right conditions. The dollar's a little higher this morning. The dollar was sharply lower yesterday, and that didn't do too much to help us. My guess is it mostly just capped the losses for right now, at least. And we'll go to some live charts here in a little bit. Okay, so our bull and bear risks here. The big ideas about yields, that is our number one thing that can happen. Can it happen? Yes. The downside risks that could drive if we only see a small decline or steady yields, that is a problem. And our other downside risk, if these improved export numbers don't come to fruition. Export sales came out this morning. They were a little bit better than expected. And these low prices, now is a pretty good spot if you want to take some coverage. So we may very well see an improvement in export sales, and that can help us. Again, much like we saw with the wheat market after we went to $12 and fell apart, this is where we can stop the bleeding. I'm not going to talk about any political risks until we get closer to the election, but there are clearly degrees of political risk and unpredictability that are definitely happening here.
Sterling, we saw that on Monday. The market maybe a little bit premature, but a knee-jerk reaction, and all of a sudden Monday morning we're factoring in a trade war with China after the events over the weekend. So you're right, a little bit premature, but there are some undertones there.
There are undertones and things that can happen, and hopefully they learn from the previous behaviors, which the only thing that happened with the trade war, the only thing that happened was you increased Brazilian production. That's the only outcome of that.
You've got a chart out there, and I think that probably the one most remarkable ag production fact across the globe is the growth in Brazilian corn production at a little over 5 billion bushels. That's up from 3 billion not long ago. I want to say maybe 4 years ago. So incredible growth down there.
Yeah, a 50-60% increase in corn production and a solid 25% increase in soybeans. At the margin, that makes a very, very big difference. And it didn't happen naturally. That's the problem. If it occurs naturally, the market can handle it. This was a situation where China needed soybeans and they don't want ours. They went and found them. And that artificially increases the supply faster than our consumption supply can catch up. Our consumption side will catch up. And that in turn prices the resolver and it drives prices down. Moving on to soybeans. So we cut ending stocks for soybeans by about 20 million. This pretty much corresponds with the cut in production ideas. We took production and we cut that back from, or increased it from, well, actually we took it back down by about 15 and we added 20. So pretty much a net equal item there. We left exports unchanged. This 52 number yield for soybeans, that isn't the record. Can we do it? Oh yeah, we can definitely do it. If we see a pretty good batch of rain, again, the weather over the next 2 to 3 weeks is going to matter. But remember, these soybeans got planted a little bit differently. Some of these soybeans got planted very, very early and have seen exceptional growing conditions, particularly here in Nebraska and some parts of Iowa. We have got plenty of moisture in here for these things. And that is going to create a situation where we may very well be looking at our yields for soybeans, maybe 52.3, 52.5 is definitely in the cards. Right now, Planalytics is at 51.9, and yield estimates for soybeans typically run a little bit low because you're never really quite that sure down to that decimal point until you actually harvest them. But again, the same story for soybean conditions as we have seen for corn conditions. Higher for longer. We are doing much better, and on a seasonal basis, we are seeing excellent conditions further into the growing season than we have ever seen before. We couple that with what is in fact a longer growing season, does create the situation where we may very well see some additional soybean production.
Sterling, taking a look at this, I really think, a lot of people ask how low can these prices go if these projections are right. And I really think we have to go back to early 2020 to get any kind of idea of what we're dealing with these kind of stocks. So if you kind of go back in time with me, early 2020, it's the COVID outbreak in China. Things seem hopeless. Okay. January, February, March, farmers can get $4 for their corn and $9 for their beans. They're going to take full advantage of this. Okay. Now, at that point in time, we had basically cut back on what China was going to buy from us. Okay. We
Okay.
had carryouts on corn projected. This is projected, not real, at 2.7 billion. I saw carryouts on soybeans, Sterling. This is kind of a crazy number at around 700 to 750 million. These were projected. They never came to
Mhm.
fruition. We know that.
Right.
But those prices, how low can we dip here, Sterling? It doesn't seem like we can go back to those types of levels, but we're not far off on corn right now.
Now, corn at 405. I think if you breach the $4 level, I think that is the level that attracts commercial buying and export interest. I think it's easier and safer for most other places. Now, again, this we start to steer back to these political concerns. Who is far and away the biggest buyer of our corn? Far and away.
Or I mean, what looks like it will be is Mexico.
Mexico consistently in this year by, if you look at the charts in today's export report, by a huge margin. And they are having their best year ever. If we end up with a problem with Mexico and start to create a trade row or something going on there, that could create a problem. I don't necessarily see that happening, and that's a long way down the road. But, when you have a bull in a china shop, they may not care exactly what happens. Assuming we can avoid those problems, I think the 390, 395, $4 area is an area where people are going to be happy to take coverage.
And to
Your
give you an
downside
idea,
risk.
if we went back to that 2020, we were seeing futures in that 340, 350, and the carryouts were projected to be much greater than what they are today. So Sterling's numbers, I think, seem right on the money.
And that should be what happens with soybeans. Right now, we have November beans at 1036. The good news is our crushing numbers have gone up. There is additional crush capacity that wasn't here 3 or 4 years ago. We are doing a good job of selling soybean meal. Our exports for soybean meal, that market is changing. If we have a little bit extra right now, our crushing's at 24.25. If we could get things moving a little bit, if we could add 100 to that, 75 to 100, that takes some of that downward edge off the soybeans. And I think really somewhere around the 1025 to 1030 area. Again, China's probably not going to step in here and buy any soybeans. But hopefully our friends in Rotterdam come in here and buy some and buy additional meal from us. Hopefully our friends in the Philippines buy some. They have emerged as a better buyer. So hopefully we can get to that situation, and then we channel into some risk and some things that would come into play with La Nina, assuming it happens when we start to look at planting the South American crop. That's about the best I can offer. I'm not going to tell you here that, oh, we're going to have a sudden weather shift and all that with the soybeans. No, we've gotten this far. If anything, our risks here are tilted to the fact that we could have better yields.
Jason brings up a good point in the chat box here. Unfortunately, it takes 480 to produce a bushel of corn, he says, and we are going to be under production cost for a bit. And while I think we're going to see commercial selling, which is essentially farmer selling, be strong the next 40 days, it's going to be a challenge. I mean, when you've got notes to pay off, operating lines at 7.5% to 9% interest, I'm afraid there's going to be selling even below these production costs just to make cash flow work over the next 3 months, especially over the next 45 days. Farmers don't want to carry this old crop in the new crop.
No, and that's fully understandable. The new crop is going to be large, and we're probably at best, we can kind of picture this prices come down. We may go sideways along the bottom, and that may prove to be an extended thing that could stretch easily into the fall. If we actually see these 181 harvest numbers and they come to fruition, well, that's going to lead to additional farmers selling, and that is going to put additional pressure on this market.
Sterling, we've got another question in the chat box. It seems most of these chats are I've got one I missed on here earlier. Wayne asked, do we think China may step in and buy with the fear of a Trump White House prior to the election? I'll let you answer that question.
We might see a little bit of buying. The problem is they can come in and buy it and fix the price. The export, the tariff will actually happen on the way out the door. So if they were going to do it, they would want to take delivery right now, which what I have noticed with the export sales, when people do come in here and buy this, they are taking it straight away. They are not waiting. And that's not just China, that's everybody. Everybody is what we call hand to mouth, meaning I call up my guy and I need to buy 100,000 tons of corn. I buy the 100,000 tons of corn on Tuesday. By Monday, it's on a ship and on its way.
I
So
think you
that
make
is
a really good point there, Sterling. We talked about the value of the dollar. Yes, it can have impact on these export numbers, but largely the world's going to buy the cheapest supply until they're gone. They're going to come to us afterwards. Maybe it slows the pace of how they buy for the U.S., but right now it's not a question of whether I come to the U.S. or I come to Brazil for that corn. I'm going to go to Brazil until it's not there anymore.
exactly. In China in particular, we will be the buyer of last resort for corn. There is no question about that. The question is, how do they feel about us for their soybean needs? How big will the Brazilian crop be? I mean, the USDA has ideas of 165 million tons. That is a big, big crop. That will definitely hurt our exports going into China, and we are going to have to find other places to move these beans. There's just no way around it. Or, we're going to have to make sure our crushing plants are running full steam ahead and doing a better job of moving out the soybean meal, which is something with the use of soybean oil and biodiesel and things, is in fact a good thing. Because there are plenty of countries who are quite happy to buy the meal. They don't really necessarily have the crushing capacity themselves. And that's something that that will be, I think, the golden end of things for soybeans. So
We're looking at this thing, and I know that there's always going to be opportunities here. And Sterling's pointed out just a couple of those with the spec funds being as short as they are. They can always surprise us with their timing, with their run up. Um, problems with the Ukrainian corn crop adds to U.S. exports out there. There's those things that can trigger the market, but we're painting a picture of just simply not enough demand to keep up with this overall supply. And there's always going to be these blips. We just got to really take advantage of them when they occur. I wish we knew when they were going to. They will, but we've got to be on top of them when they do.
yeah, if we can improve, the feed numbers, more chickens would be the first thing. I do think where hog prices are vis-a-vis cattle prices, you can see increased hog production. We do have a shortage of cattle, and I think where cattle prices are right now, that should begin to move and improve, but that's slow. That will take 2 years to come into play, where chickens and hogs are something that can happen a little bit more nearby. A little better ethanol use would be good, but we can't count on those miles driven going up either. And one thing, I'm trying to steer clear of politics, but I can't avoid going here. We saw what Elon Musk did, and he's pledged $40 million a month to the Trump campaign. Now, Mr. Trump had been previously anti-electric car. How is this going to play out? How is all of this going to work out with Elon Musk, the biggest manufacturer of electric cars, now being a major contributor? That again is something. We'll see how this plays out, but that is a bit of a concern that we could see, a speeding up of the electric situation, despite the normal inclinations we think of what the Republican Party is going to do.
It's amazing. It's amazing how we can see flip flops in the political realm when it can impact the bottom line.
Oh, and the thing is, what you have to do here is you have to sort out the political rhetoric from the economic fact. And politicians in economics aren't much better than politicians in bioscience. They will phrase it and frame things that maybe just aren't exactly congruent with what the economic realities are going to be. So again, we'll pay attention, and it's too early to draw any conclusions, depending on who wins the election, and depends on who's actually running in the election. Because once again, we have those issues around President Biden. As I warned Brooks, when I go off the desk, things get out of hand in a hurry.
I think we were thinking more of a rally, though, Sterling. I didn't think it would be a political firestorm. I thought we were going to rally corn 30 cents.
Yeah, that didn't happen this time. We need the weather to change for that to happen. Okay. Soybean fund position here is we are short. We are short 175,000 contracts, and we're not quite to maximum short, but we're pretty close. And if we get some weather, there is probably a little bit of room for funds selling right now with November 1039. That's enough that could take you down to that 1020 area or so. But at that level where crush margins are right now on new crop crush, we're at $1.31 and we're at $1.56 on old crop. That's huge. That's good. And that is something that can support soybean prices, because clearly crushing soybeans is working, and working not like it did at pandemic high levels, but for ordinary conditions, we are working very nicely. If we were to see a rally in crude oil, that would push soybean oil up. That would improve these margins, and these guys will be running their plants full speed. So that is, again, probably the second biggest driver after the weather here. So again, something happens. There is obviously more likely a proclivity for short covering, especially if we get to that minus 200 level with soybean short position. We'll go over the charts here. And that's pretty much one of the biggest handicaps for the soybean market is, in fact, the corn market. If the corn market remains heavy, that's going to work as a weight around the soybeans until they can break loose a little bit, and we can get some concerns about South American planting going forward. Moving on to the wheat market, once again, we saw ending stocks actually go higher a little bit, a change of 98 million bushels. And we saw yields per acre move up by 2.5 bushels, and we saw harvested acres go up. So everything in this formula seems bearish, but yet wheat, in Minneapolis, we're up about 10.5. In Kansas City, we're at 562.5. We're up a little bit, and Chicago down 5.25. So the wheat has actually held up a little bit better here. And again, to get the wheat market moving, the U.S. is not a big leader in wheat exports. And as you can see in this balance sheet, they did push exports up about 25, and that's good. And that's running 108 better than it was last year, which again, last year was a dismal year for exports. Hopefully these lower prices do attract some additional buying. And if we see problems again in the Ukraine, there were some issues with the French wheat crop and its quality, would tend to be supportive. If we're going to see bullish action in the wheat, most likely it's going to start when we get past the winter wheat harvest, and we're going to need Kansas City most likely to lead us higher. Growing conditions for the Minneapolis wheat for the spring wheat are spectacular, again, just like they are for corn and soybeans. Again, better, higher for longer, and the conditions of that crop probably are going to be a little bit of a restraint on prices. But when we get past the harvest pressure in Kansas City, perhaps that can start to lead and pull the whole complex higher.
Sterling, I don't want to shift gears here, but I want to acknowledge some of our chat questions. Any updates on renewable fuels situation? Hoping that helps out with demand.
As far as what I've seen on the renewable fuels situation, I haven't seen any updates or any changes in any regulation. By the same token, I was out of the country for 2 weeks and wasn't
Yeah,
really
I think
watching the
the
U.S. news,
question.
which was here. You want to know what the best part of the vacation was? Not hearing any news from the U.S. or hearing only minimal U.S. news. That was the best part.
Was probably a good part.
Yeah.
Well, on the E15, I mean, Jason, you asked the question. I think we could fall back to, again, the political ramifications of that. I think that we'll know in 6 months where we land there. As far as SAF, no news at all. And we've known that SAF is a long term situation. We're looking at 7 or 8 years, I think, before we see anything form out of that. Sterling, any different news than what I've got?
I have not heard anything about it whatsoever. But again, I wasn't really in a spot to hear any of it either. So gas is a lot cheaper here than it is in the Netherlands. In the Netherlands, premium was running $2.32 a liter outside of Amsterdam. That equates to about $9 a gallon.
Wow.
That's why most of the cars you see are about half to a third the size of the cars that we actually drive. I think the entire time I was there, I saw 2 pickup trucks, absolutely no really big SUVs, a lot of Teslas, a lot of Teslas in the Netherlands. So let's take a look here at some charts here and see, what we have going on. We'll start with, and this is December corn. As you can see, right now we have support. We'll just call it $4, and we'll just live with that. All the numbers down here are basically oversold to deeply oversold, and we have a large fund short position. That normally is a formula for some sort of bounce, but we are going to need something to drive this higher because the fundamentals in the market are not going to change overnight and they remain heavy. So, again, if we could bounce to 425, that's probably about what we could hope for. And on Tuesday, I'll have all new technical measures and everything going on with that. So there's fuel here, but I would maintain low expectations on prices going higher until we get to a level where we can really spark some commercial buying and people really want to come in and buy this. It's going to be difficult. There's just no way around it. Moving on to the November soybeans. Well, what's today's low? Today's low is 10.31 3/4. We're 7 cents off of that. That's good news. So again, about 10.30 is probably the support area for right now, and we're dragging against it. We're trading below all the moving averages. The stochastics are amazingly low at 6.9 and 10 even. We can't go to zero, but we're getting awfully close to zero. The RSI at 23 again is deeply negative, but we can hold that for quite a while. Again, the fact that we've gotten so cheap, there's probably room for another 25,000 in funds selling. Discounting that, maybe we can hold these levels if the dollar can stay soft. Moving on to wheat. Wheat actually looks a little bit better here. We have for December Chicago wheat clear support at 550. If we can finish higher today, we have a 4-day pattern that with a higher close is bullish. With a lower close, it's noticeably bearish. We're deeply oversold. So if we could push higher, there may be a little bit of room for a bounce in the wheat market. If the wheat market can, in fact, bounce, that is something that normally would help the grain market rally. Right now, I'm viewing not going down as a rally. Yesterday, the dollar index was down 50 points and we did nothing. If the dollar had been steady, we would have been lower. Okay. So right now, our bullish factors are best viewed as breaking the downside. We have Homer Simpson going over the cliff. And right now, if we can just stop the dropping, that's really what I think we're going to be getting out for bullish things. unless we see, some major export sales. We did see those in wheat. Egypt came in, I think it was on Tuesday, bought about 717,000 metric tons of wheat. Granted, they bought it mostly from Russia. That was the biggest wheat tender in like 3 or 4 years. So that definitely did change things a little bit. And if we can get the wheat stable to higher, that will work to stabilize corn and soybean prices some. All right. So did we have any more questions, books about the grain markets before we go talk about some other things here?
I don't think so. Let me check here. No, I think we're good, Sterling.
Okay. All right. And this is going to be the last bit of bad news. Okay. Okay. After this, I'm going to have good things to talk about. This is a chart of crude oil. As you can see, we're a little bit lower today, but we are generally moving higher. We are getting a little bit of a bullish cross here, and we held the $80 level. The weakness in the dollar is something that is supportive to crude oil prices. We have seen demand get a little bit better globally, and this has worked to push crude up. We've had a little volatility in the stock market and some odd rotation and some strangeness going on, but the market recovered, as you can see. That's yesterday. That's the day before yesterday. Clearly, there's people willing to buy cheap crude oil, or at least what they perceive as being cheap, which is south of $80. And if we see another turn and reversal like this, we are setting ourselves up for a potentially higher crude oil market. So that will lead to higher diesel and higher gasoline prices, which I'm sure the administration coming into an election is something that they don't want to see. Now for some good news. This is a chart of 10-year interest rates, and we are at 417. If we look at 30-year mortgages, they are back below 7% this morning, printing somewhere, I think they're even below 6.9% as the generic rate goes. The CPI numbers, while I was away, were noticeably better. We most likely are looking at a rate cut in September. As long as we don't get any inadvertently strong economic data, I would suspect that we are going to we will get a rate cut. Is this the start of a cutting cycle? Probably not, but that will work to cap interest rates and perhaps slowly begin to work them lower. Just looking at this chart from a technical point of view, most likely before this happens, we are going to get a little bounce. And that bounce could probably take us from 416 to 435. If you see that bounce and you're a person who likes to buy bonds or invest in bonds, those numbers would probably be fairly good, and that may very well be the best level that you're going to get. You can kind of see trend line here where we're seeing descending highs, and if they start to cut rates and you buy bonds, the actual cash value of the bond goes up, so you can experience equity-like market returns with security while drawing interest. So that is one piece of good news. Other item here, if we've been watching the stock market, we had seen that the Dow had been massively underperforming the S&P. The S&P had been moving up noticeably higher. The NASDAQ in particular has moved up meaningfully. We saw a big reversal of that yesterday. The NASDAQ was down about 2.75%. The S&P was down 1.25%, and the Dow set a new record high. We are going through a period of rotation that will be a little bit violent. We've seen small cap stocks gain 10% in over about the last week and a half. So again, we're going through a period of adjustment. Most likely, just looking at this Dow chart, it looks like we are probably overextended to the upside on the Dow. And once we get the S&P and the NASDAQ somewhat corrected, we will probably see a big correction in the Dow. And we will probably see a recovery after that. What the market does after the first rate cut can be historically is highly variable. Sometimes it's bullish, sometimes it's bearish. and then we throw in the additional concerns about the election, we could be entering a period of volatility. However, if earnings stay strong, we do not see weekly jobless claims go above 300,000 a week. Most likely, if that continues 6 months from now, we will be looking at markets that are higher than where they are today.
Sterling, throw something out, some articles I've been reading mainly out of JP Morgan, talking about how investors have changed, protecting themselves from violent downside moves. Traditionally, maybe they've shorted calls, covered calls, maybe they have bought puts on an indice. Are they staying out there now, and are they cross investing maybe in metals and energy rather than those traditional ways to protect long equity holdings?
Well, I think when we're looking at major Wall Street money and looking at the price action, I think the trade had been buy NASDAQ, buy the Mag 7, short small caps against it. That had been the trade the hedge funds are doing in size and in mass. And that would explain we see the NASDAQ go down and we see the small caps snap higher. And the small cap stocks, remember, we're dealing with companies here that have no earnings for the most part and are very interest rate sensitive. So we have seen that part of that trade twist off. If you're buying gold as a hedge against a stock market crash, here is my warning. Be very, very careful about what you wish for. Normally, when the stock market crashes, it rips gold along with it. If you're worried about a serious equity market correction, buying 2 to 12-year duration in the interest rate market is the best choice. Do not buy a fund, however, buy hard bonds. Those tend to perform the best. Interest rates tend to come down. The Fed would most likely act and drive rates lower. And again, you can see that equity market performance with with bond interest. That is probably the best move with that. Buying energies and buying metals, you need to do their things on their own merits. The policies of both presidential candidates are inflationary. To which degree and how you want to blame or put the causations of the inflation we have now, I could argue either one caused it quite convincingly. But when you put in things like tariffs, if you listen to J.D. Vance's speech last night, those sorts of things will lead to inflation. So from that point of view, I do think that gold on dips is a favorable thing. Just be cautious and aware that if we have a stock market problem, you may go for the ride. So if you're trading futures, use stops, guard profits. But structurally, we'll have that behavior, but we may have a lot of dents, bangs, and clanks on the way. If we saw a big break in gold prices, I think that's something that would be very interesting and rather tasty.
I think you summed it up well there. And not to get too political on this, but there's not a lot of difference in fiscal policy out there. When we look at the prime causes of this inflation, we might go back to that Trump administration that the last 2 years was dominated with a Democratic Congress. And when we look at that CARES Act, Sterling, that CARES Act was supported by both sides, and that CARES Act poured a lot of money into an economy. That a lot of people kind of point to that legislation as one of the main causes, and it was supported by both sides of the aisle.
Yeah, and again, the pandemic was a different situation. And while we're squawking about about the inflation we've had, and I will be the first to agree, it's been a pain in the backside. It does not compare anything to what we had in the 70s. Not even close. So if we have pretty much cured the inflation problems and can avoid any major disruptions, yeah, we're probably going to look at running 3% inflation normally. If the Trump administration gets their way, comes in, and if that's what happens, and he insists on driving interest rates lower faster, that in turn can create inflation. The biggest complaint about the economy right now is the 3.1% inflation. and the effects of the inflation that we saw previously. Unemployment remains very low. The Dow put in a new record high yesterday. So it's kind of hard to sit and scream that the economy's bad. Statistically, it's not bad. But for a lot of people, it doesn't feel very good. And that's who the political parties are trying to coax as their voters. Because keep in mind, you've got a third hard on the right, a third hard on the left, and you got the third in the middle, and that's who they're fighting over. So, again, what kind of policies we actually get, we'll see. But being both known entities, I think we can pretty much figure out about what's going to happen, depending on who lands where. Put it that way.
Lots of unknowns at this point in time. Sterling, we're down to the last 15 minutes or so of the meeting. I'll talk a little bit about Farm Bill, and I want to throw in a pitch here for Acre. Farm Bill right now, I can tell you what I think can transpire in this new bill, but until it's signed on the dotted line, it's really hard to predict. It seems like we get points of momentum, and then we have a lull, and we're in that lull right now. I think I would have told you 3 weeks ago, September seemed like the perfect time to get a farm bill passed. Doesn't necessarily seem like that's the case over the last week. It seems like it's something that is starting to become unlikely. All the more reason. I could tell you a few things that I think are going to be in there, like enhancements to SCO, inflation adjusted A&O, our safety net programs, PLC, ARC changing slightly. If you look to the Senate, maybe enhanced premium discounts to multi-peril. All these things are, for the most part, looked at as beneficial to crop insurance. But unless we really keep up on relationships that we have with Acre, and you can check out Acre on social media to learn more about it, they're not certain. And one thing Acre does that's a little different, we're not a lobbyist group, we're more like a relationship group. We keep in touch with members of the ag committees, their staffs, really kind of help educate them to the details of crop insurance. But if you look into Acre, we could use as many members as we can get there. I think there's power in numbers. If you got any questions on that, don't hesitate to reach out to me on a text, email, and I'll teach you a little bit more about that group doing some pretty good things in DC. What have you got for us here, Sterling?
Just putting up a chart, just putting up the picture of where the markets are right now here as we're coming into the end of the meeting. December corn at 405 is down 6 3/4. November beans 1039 down 1 1/4. Again, the best news for the beans right now, meal is doing okay, and we've actually had soybean oil turn positive, leaving us good looking crush margins. Star of the show today is Minneapolis wheat up 11 cents. We didn't talk about cotton during the meeting. Cotton's balance sheet was actually kind of bearish. We increased production, we increased acres, we increased yield, we increased ending stocks. Cotton got a little bit of a bounce. Cotton kind of, it doesn't trade as uniformly in the futures market as the grain markets do. After you go to July, you immediately move to new crop. So the risk profiles for the futures market changes a little bit. And that prompted a fair amount of short covering in front of that rollover out of the July contract. That pushed prices up. And right now we're kind of wavering here, and I'm a little concerned if we see weak exports. China has been very good. They have been a big buyer of our cotton, and they've had a good year of buying cotton. If we see trade problems with China, that could become a problem for the cotton market again, and that could kind of weigh on things. Again, fashion is out of fashion, and clothing sales are difficult right now. With the exception of expensive ladies' handbags, I've never seen so many expensive handbags in my life. Both in Antwerp and the airport in Amsterdam. And crude oil getting beat up a little bit, seeing a little bit of weakness here. And kind of a choppy, nervous stock market. I think yesterday's big drop in the NASDAQ gave everybody a little bit of a scare, and people are kind of reassessing and adjusting positions. That's what's driving that. And cattle futures are coming a little bit lower. My guess is there we're seeing a little bit of weak cash sales going on, as packer margins have again turned negative as cutout values came down sharply over the last couple of weeks.
So, Sterling, are we at the beginning stages of the BLT market right here?
We are right now. We are at the land of the BLT. We
All
are
right.
starting. It is happening right now, and we should watch belly prices and see if they improve. If they improve, we should be able to work to lift the hog market. Now, if you're trading hogs, one, congratulations, you're brave. I appreciate what you do. We've rolled over into the October hogs right now, and October hogs are here. Let me get down here where we can see it a little bit. August hogs are at 91 even. October hogs are at 73.27. Okay. Cash hogs right now are about 86 cents a pound. So we have a deep discount in October and a bit of a premium in August. And August won't be coming off of tradability for another couple of weeks. So we do have a stage for some volatility here. And with the October's trading 12 cents under cash, if we can have a good BLT season, that could create some upside opportunity within that October futures. So that is a little nuance of the hog market. As you can see, serious contango here with August trading at 90 cents and December at 65 cents.
Very good. Very good. Well, Sterling, I don't see any other questions out there. And as you can tell by the sound of my voice, I didn't want to show my face on camera too much. I've tried to mask coughing in between comments. So I apologize for not being a very good color guy when it comes to the play today. So you pretty much run it yourself, and I appreciate that.
Oh, that's not a problem. I got over my jet lag, so I'm fine. And I don't buy a jet lag excuse for 10 days. One day lagging can be a little bit of a pain, but you should be able to recover pretty quickly.
All right. Well, I'll let you take us away then.
All right. I'd like to thank everybody for their time this morning and make sure to read all of the daily comments because, again, we are in a volatile period and things we can take advantage of will happen quicker and they won't be as big as what we are used to. It is the middle of July. Our next big meeting will be for the August WASDE, and this should be very, very interesting. As again, we are going to have a grab on yield ideas that's going to be a lot tighter than where we are right now. We will have maybe some better political ideas and how that's going to affect the currency markets and everything else going on globally. So make sure to join us for that WASDE meeting. Also, watch your daily emails. You'll have a recording of this meeting will be available in there. I'm also doing a webinar with Bloomberg this afternoon, along with Jeff Doran with the weather, and my friend Jason Miner, who is an ag chem guy, and we're going to be talking about what's going on with all of that. And when we have a recorded copy for that, we will put that into the daily emails for your perusal as well. So with that, I'd like to thank everybody again. And from Omaha, Nebraska, have a great day.